Welcome, my name is Thomas Nygaard from Norsk Forening for Quantitative Finance. Great to see that so many people showed up here today for our seminar. So we have I will start by saying something shortly about our association. After that, we are very proud to have with us Professor Marcos Lopez de Prado, who will present his latest book. Marcos Lopez de Prado is the CIO of True Positive Technologies. Before that, he was head of machine learning at AQR. He's written 2 bestsellers about machine learning for finance. After the presentation by Marcos of about 40 minutes, he will answer questions. So there is a possibility for all attendees to write questions in the Q&A, which we will read to Marcos after his presentation. After the first hour, we will then have the final for our call for papers. We have a call for papers sponsored by Noorquant, who there will be 4 finalists who will present their papers. We have a jury here who will select the winner, who will receive 20,000 kroner and a possibility for an internship with Noorquant. But before we start with this agenda, let me just say a couple of words about the reason why we are here, and that's our association. Norsk Forening for Quantitative Finance is a relatively young organization, but we feel we've accomplished quite a lot already. The goal of the association is to promote a quantitative, research-based method in finance. We're also an open association. We aim to include not just the financial industry, but also academic environments, academia, students, research institutions, and investors. We have been quite active on LinkedIn, so most of you have probably know us from there. We have a LinkedIn page and two groups, mainly for Norwegian financial professionals. It's Quantitative Finance with well over 2,000 members, and Machine Learning for Finance with well over 1,000 members. On our website, NFKF, you can read more about our activities, our board, and it's possible to subscribe to our newsletter. Our main activities has been seminars. So last year we had 8 seminars with close to 1,500 participants. This year we started out with 2 seminars, but of course, because of the coronavirus situation, it's been more quiet. This is our first webinar, and we're quite happy. We have several hundred registrations for this webinar, so it's a great start for us for our online activities. If any of you participating here, attending, is interested in organizing a seminar, please contact us. So we have a busy schedule here today. So I suggest I give the word to Professor Marcos Lopez de Prado. Welcome, Marcos.
Thank you, Thomas. It's a pleasure to be here. Today I would like to discuss a very important problem that we all face in investments, and that's how can we allocate assets, how can we build portfolios that are diversified and that are providing good performance out of sample. So this is a problem that originated earlier on in finance in the 1950s. That's when Harry Markovich made his great breakthrough of how to develop portfolios that are well diversified, where we can obtain a high level of return subject to a certain level of risk. And that gave birth to modern portfolio theory. Over the past 70 years or so, this has been the benchmark for most firms who approach the problem of asset allocation from a convex optimization perspective. Now, we have to understand that there are a number of pitfalls associated with this approach. As valuable as it is, it is very well known that convex optimization solutions in general are unstable, they lack robustness, and the purpose of today's seminar is to introduce machine learning techniques that help us address many of these caveats. So we can summarize the two sources of instability that we observe in portfolio optimization as two. Number one, noise-induced instability. This is instability that is associated with noisy inputs, noise in the covariance matrix, noise in the vector of expected returns, but then also signal-induced instability. This is a far less known and often misunderstood source of instability, as we will see in a moment. But first of all, we need to understand the problem. Let's state the problem that portfolio construction and convex optimization solutions to portfolio construction try to solve. Suppose that you have an investment universe of 10 assets. These are random variables where the expected return of those variables is described by an array mu, and the covariance matrix models the codependence between these variables. The objective of convex optimization is to minimize the variance of the portfolio, represented here as the objective function, subject to achieving a certain level of return or some other condition that we want to establish. Typically, this is expressed in terms of return, but sometimes you can introduce here some other constraint, which is characterized by this array A, also known as the characteristic vector. Typically, in a convex optimization problem with equality constraints, you can solve these using Lagrangians. The important piece of information in this slide is at the bottom, where, as you can see, the optimal portfolio results from the product of the inverse covariance matrix with the characteristic vector. This is problematic because if the covariance matrix is unstable, is numerically ill-conditioned, its inverse is going to magnify any of the errors associated with noise in the vector of expected returns, or in particular, but in general, with the characteristic vector. So think of a covariance matrix that is numerically ill-conditioned. This means that the determinant will be small. As a result, V inverse is going to have some numbers that explode because they are these numbers are divided by another number that is very close to zero, the determinant, and as a result, any error incorporated in A is magnified by V inverse. The solution also happens to be a minimum, which we can verify through the Hessian of the problem. Now, the numerical instability appears because we do not know the true V and we do not know the true A. We only have estimates. So we replace in this optimal solution V and A with their maximum likelihood estimates. And that's where the solution, which is mathematically correct, now happens to be in practice problematic. The two kinds of problems that we will examine next is noise-induced instability and signal-induced instability. So what is noise-induced instability? To understand where noise-induced instability comes in, we need to review a little bit of random matrix theory. So again, consider that you have your investment universe of size n, you have T observations, so the X matrix of observations is of order T by n. And further, suppose that these variables are random and the observations are independent and identically distributed. These observations will have a mean of 0 and a variance of sigma squared. So if the observations of the portfolio do not have a 0 mean, they can be easily centered. The variance of the observations will be sigma squared. Well, this means that matrix C can be computed as x prime x divided by the number of observations, and that represents the covariance matrix. Now, applying random matrix theory, we know that as n grows, the number of columns in the X matrix grows, and the number of rows in the X matrix grows, as long as this ratio T divided by N is greater than 1, the Marchenko-Pastor theory tells us that the probability distribution of the eigenvalues associated with this matrix C will follow this function. The important implication of this is that when we compute the eigenvalues of the covariance matrix, we will observe that these eigenvalues are bounded between two levels, lambda minus and lambda plus. And the important expression in this slide is to recognize that both the lower bound of the eigenvalue and the upper bound of the eigenvalue are a function of this very important expression, n over t. When we have many columns relative to the number of observations, lambda plus increases and lambda minus decreases. It means that the distribution widens as we increase the number of columns relative to the number of observations. Why is this important? Well, it is very important because it means that when we have a relatively smaller number of observations, now the lambda minus will become smaller, and eventually it will become very close to 0, which means that the determinant will be very close to 0. As you remember from linear algebra, the determinant is the product of the eigenvalues. So what can we do about this? Well, we can fit, given a covariance matrix that comes from Barra or any other vendor, or that you compute yourself, what we can do is we can fit the eigenvalues of that covariance matrix to the Marchenko-Pastor distribution, and you will obtain a plot like this. This plot will indicate an area under which the large majority of the eigenvalues fall. These are eigenvalues associated with noise. Why? Because the Marchenko-Pastor distribution is the distribution of the eigenvalues of a random covariance matrix. So all randomicity, all sorts of noise falls under the Marchenko-Pastor distribution. Then there will be a gap. Beyond that, there are some eigenvalues that are too large, too strong for being associated with noise. The Marchenko-Pastor distribution, when fitted properly, allows us to separate the eigenvalues associated with noise from the eigenvalues associated with signal. And this is very useful because it means that now we can denoise the covariance matrix. What do I mean with denoising? Well, since the eigenvalues that fall under the Marchenko-Pastor distribution are associated with noise, we can transform them in any way we want. They do not carry information. We can transform them in any way we want in order to improve the numerical properties of the covariance matrix. So one approach is to take any of the eigenvalues that fall under the Marchenko-Pastor distribution and replace them with their mean. Why with their mean? Well, because we want to preserve the trace of the covariance matrix. And as long as we replace these values with their mean, the sum of the eigenvalues will still equal the trace of the original covariance matrix, while we accomplish the goal that the minimum eigenvalue is now equal to the mean eigenvalue under Marchenko-Pastor, which means that it will be larger than lambda minus, the lower bound of Marchenko-Pastor. So this is what we call the constant residual eigenvalue method. We just, as you can see in this plot, we take any eigenvalue below that is below lambda plus, and we replace it with the mean here in log scale, which means that there is a point beyond all eigenvalues are constant. And as you can see, the smallest eigenvalue is much larger than the original smallest eigenvalue. So this accomplishes the goal that now the determinant of the covariance matrix is way larger than the eigenvalue of the original covariance matrix. The second approach is to shrink the covariance matrix associated with noise. Essentially, we can form a covariance matrix associated with the Marchenko-Pastor distribution, with eigenvalues under the Marchenko-Pastor distribution, and that's what we're going to shrink. So rather than applying Ledois-Wolff style of a shrinkage to the entire covariance matrix, what we will do is we will shrink only the eigenvalues associated with noise. This has the benefit that, as you can see in this plot, all the eigenvalues associated with signal remain essentially unchanged. So we do not lose signal, but we are able to remove a lot of the noise. Now, there is a second transformation that is very useful, and that's detoning. The idea of detoning is that there are certain eigenvectors associated with risk vectors. In fact, there are some risk associated with that impacts all of the variables in the system. You can think of sectors or market or region-based risk. So these risks impact all of the securities, which means that these risks are not particularly useful in terms of allocating assets between one group and another. Why? Because if everything is exposed to the market, well, this does not help us much in terms of differentiating security A to security B. We still are interested, of course, in the degree of the exposure, but most stocks, for instance, exhibit very high correlation to the broad market index. This means that information about the risk, the market risk, is not particularly helpful in terms of discriminating between the various securities. So the idea here is we are going to remove the broad market exposure, and after we remove that dimension, we can do an allocation for the rest. It is essentially the same as if you are in a public place, let's say in a party, and there is a background noise. This background noise doesn't allow you to hear a conversation. So what you would like is to cancel the background noise so that you can amplify the information that you're getting from a different channel. So the same happens here. We can remove the market component, typically the first or second principal component, and then we can do an optimization on the rest. Whenever we remove one dimension to the system, it means, of course, that the correlation matrix is not going to be invertible. In fact, it will be singular, but that's not a problem. What we can do is we can do the allocation on the reduced system, and then we can map back those allocations to the original system using the eigenvector matrix. Well, does this approach work? There are essentially two ways we can evaluate whether these methods work in practice. One would be to run a number of historical simulations, and another approach is to run Monte Carlo experiments. In this case, I'm running Monte Carlo experiments. Why? Because the question is whether this approach works mathematically. Does this approach have good mathematical properties? A historical simulation would give us anecdotal information as to whether a particular approach would have performed for a single path, the historical realization. And in that sense, it's not powerful enough. A historical backtest is not powerful enough to reach a conclusion as to whether a particular approach works mathematically or not. In statistics, whenever we want to evaluate the characteristics of an estimator, or a particular model, what we do is we run Monte Carlo experiments because we want to understand the properties of an approach while controlling for the conditions of the system. So what I've done here is I've generated a covariance matrix of size 500 by 500, which is representative of the S&P 500, and I've added a market component. I've added sectors components, so there are essentially 10 clusters of stocks, one representing each sector of the economy. And then what I've done is, given these ground truth, this covariance matrix, we can sample covariance matrices. So for each, we can sample 1,000 observations from the ground truth and form a covariance matrix, and then another 1,000 observations form another covariance matrix. In that way, we can generate thousands of random covariance matrices, all of them drawn from the original ground truth. And for each of these random covariance matrices, we can apply Markovitch style optimization, for instance, the standard critical line algorithm. And for each of these critical line solutions, we can compare the result with the original, the result that comes from the ground truth that gives us the estimation error. So this Monte Carlo approach allows us to derive the bootstrap of the estimation error. And we can do that for the critical line algorithm, and we can do this also for the approach that I just described. Essentially, we would apply first denoising, and then we would apply Markovitch. And the question is, by how much does denoising increase or decrease the estimation error? That can be evaluated by computing the root mean square error of this Monte Carlo. So what we find is that when we compute the minimum variance portfolio, denoising helps a lot. It reduces the root mean square error by around 60%, while Ledois-Wolff style shrinkage would also be beneficial. It would reduce by about half of what denoising accomplishes. When you use both methods combined, there is no additional benefit. Essentially, it improves a little bit over what you would obtain with denoising, but not by much. So in that sense, it appears that denoising benefits from all the risk reduction of Ledois-Wolff and more. In fact, the risk reduction is 60% as opposed to 30%. How about the maximum Sharpe ratio portfolio? Well, here the reduction is even more impressive. You will obtain, when you repeat this study at home, you will obtain that denoising accomplishes around 94% reduction in the root mean square error. So if you're familiar with financial solutions, typically even a small improvement is meaningful. After all, in finance, we are always looking after the small edges. And in this particular case, we are talking about a 94% reduction in the root mean square error, meaning that denoising is a practical and very efficient way of stabilizing the efficient frontier. But as I said at the beginning, there is a second problem that is often misunderstood: signal-induced instability. How can signal be a problem? Very often we associate signal with information that we want to capture. Signal is our friend. How could it be that signal is in fact detrimental to our efforts? Well, let's explain it with a small example. Consider a correlation matrix of 2 by 2. This means that there is an off-diagonal element here, rho. When we compute the eigenvector decomposition, this is the eigenvector, these are the eigenvalues. As you can see, one eigenvalue is 1 plus rho, the other eigenvalue is 1 minus rho. What this means is that when we compute the trace of the correlation matrix, it has to be 2, of course, because the diagonal of the correlation matrix is an array of 1s. In this case, it will be 2, and that's equal to lambda 11 plus lambda 22. So when we increase one eigenvalue, it can only come at the detriment of the other eigenvalue, because this expression must remain true. When we compute the determinant of the correlation matrix, well, it's the product of the eigenvalues, which is 1 minus rho squared. So let's think of what these two expressions mean together. What it means is that the determinant reaches its maximum when the two eigenvalues are equal to 1, but that's only true when rho is 0. So unless the correlation matrix is an identity matrix, there will be a decay in the determinant. The determinant will become smaller. And in fact, as we can see, the determinant could be 0 if rho is equal to 1. When rho increases in absolute value, the determinant becomes very close to 0. The second conclusion that we can observe here is that the determinant, in fact, when we compute the inverse correlation matrix, the inverse correlation matrix is a function of the determinant here. So as the determinant becomes very small, the values in the inverse correlation matrix explode. And that's the problem that we observe at the beginning. How is this different from noise-induced instability? Well, we have reached the same conclusion, meaning that the solution to the efficient frontier is going to be unstable, but following a different path. In this case, we reach this conclusion regardless of the ratio n over t. Remember that when I introduced the Marchenko-Pastor distribution, I pointed to the fact that lambda plus and lambda minus were a function of n over t. Here, as you can see, the inverse covariance matrix is going to explode even if t is an extremely large number. It doesn't matter what the ratio is of n over t. The explosion occurs as a result of the value of rho. So this is not noise-induced stability. This is signal-induced stability. And even if we have trillions of observations, the system will be unstable as a result of rho. And rho is signal. Rho is the information that we utilize. Even if we know the true correlation matrix, the system will still be unstable. This is what I call Markovich's course. Why? Because Markovich approach is extremely useful. There is no doubt that it is one of the milestones in investments and in finance. But we need to understand that Markovich was developed for the purpose of modeling correlations. And when we have a correlation structure like the one that we have observed before, where the off-diagonal elements are large, are quite different from 0, then the very reason we need Markovich is the same reason that Markovich will fail. So that's Markovich's course. The more we need Markovich, the more likely Markovich is to fail. Now, how common is to observe in finance correlations, off-diagonal correlations that are significantly greater than 0? Well, it's very common. When you think of clusters of securities identified with sector exposure, country exposure, region, size, as a result of all these common traits and factors, the securities will bundle together in clusters. And these clusters mean that Markovich cannot differentiate between them. When two securities are very similar, the portfolio optimization solution cannot differentiate between security I and security B, which means that even a small change in the expected return will produce a large shift in the allocations. So that's one way to understand how the previous linear algebra works in practice. In econometrics, sometimes this is known as multicollinearity, right? When you have a system where the various variables that you're trying to model are mutually correlated. And as I said, this is very common in finance. So unless we deal with signal-induced instability, Markovitch solutions are going to be very unstable. So this is where the NCO algorithm comes in. NCO stands for Nested Cluster Optimization. You can think of this algorithm as 5 stages. In stage number 1, we find the optimal clusters associated with the covariance matrix. So for that, you can use the ONC algorithm, or you can use some other algorithm that identifies not only the optimal number of clusters, but their composition. Once you know what are the clusters, this allows you to partition the investment universe into several blocks. For each block, for each of these clusters, you can optimize the clusters independently and in parallel. So let's say that the system correctly identifies that there are 10 blocks, one for each sector, and now you can produce one optimal portfolio for financials, another optimal portfolio for consumer discretionary, for information technology, etc. And now that you have optimal portfolios for each cluster, this allows you to go to stage 3, where you reduce the system. Instead of working with an n by n system, now you will work with a k by k system, where k is the number of clusters. In stage number 4, you can now compute the allocation between the clusters. So in this case, it would be a 10 by 10 covariance matrix. So now you can produce, you can estimate these weights correctly, 10 weights essentially. And in stage number 5, you compute what is the allocation per security, which is the dot product of the allocations intercluster and the allocations intracluster. So suppose that you know the weight for financials, and then you know within financials the weight for UBS, therefore you know the weight for UBS, right? Which is the product of the two optimal weights. So why does this approach work better than Markovitch? Well, it works better than Markovitch for a very simple reason. We took a problem that was ill-defined, meaning that there was a covariance matrix with all of these high off-diagonal correlation values, and we transform it into a reduced covariance matrix with one variable per cluster, where the off-diagonal elements must be very close to 0. Why? Because if they were not close to 0, then the clusters would have been merged. So clustering in this sense allows us to compute a covariance matrix that is very close to a diagonal covariance matrix, and that's the ideal case for Markovitch. So essentially, we took a problem that was ill-defined, and we were able to cast it as a well-behaved problem, where Markovitch is going to work much better. So does this work? Well, let's repeat the same experiment that we did before. We are going to take a covariance matrix, let's say from Barra, and we are going to sample from this covariance matrix many different empirical covariance matrices. We're going to compute the solution for each of them. We will compare it with the solution that comes directly from optimizing Barra without any sort of transformation, and that allows us to bootstrap the estimation errors. So that's the standard approach, how we evaluate estimation errors in statistics. In this case, instead of working with a 500 by 500 covariance matrix, I'm going to work with an even smaller covariance matrix, 50 by 50, because what I want to show you is that even with a small size problems, signal-induced instability is extremely problematic. So what we do here is we take our minimum variance portfolio, and we apply the NCO algorithm. We compare it with Markovitch, and what we get is a 47% reduction in the root mean square error. Again, very significant, just as we saw with noise-induced instability when we denoise the covariance matrix. What is very interesting about this result is that a shrinkage, in this case, as you can see, actually is detrimental. A shrinkage makes the solution even more unstable. Why is that? Well, it makes sense. When we saw at the beginning of this presentation is that a shrinkage eliminates noise, but it also eliminates signal. So when you're dealing with even a small size of investment universe, denoising can lead to an increase in the variance. So the one observation from this experiment is that do not take a shrinkage for granted. Sometimes it will help, and very often it will actually be detrimental. NCO is helpful in both cases, and when we go to the maximum Sharpe ratio portfolio, then we obtain a reduction in the root mean square of around 55%. Now, let me conclude with a framework for estimating efficient frontiers that goes beyond what I just described in terms of denoising and the nested cluster algorithm. We don't need to assume that there is an algorithm that will always be superior or that will always be beneficial. In fact, if machine learning teaches us something is that there are some algorithms that are very good at the problem, but at a different problem, there is another better algorithm. And we should take this kind of experimental approach when we optimize portfolios in finance. We should analyze what is the best optimization tool given a set of inputs. So what I'm suggesting is that we repeat the same method that I described during this presentation twice. We apply a Monte Carlo approach to derive what is the optimization method that is most beneficial for a particular problem. So again, we will take some inputs that could come from Bara or that you compute yourself. We are going to generate empirical covariance matrices and vectors of expected returns given those inputs by drawing random observations from them. And then we will apply these optimization methods, whether it is Markovich or NCO of hierarchical risk parity or whatever approach that you think is a good candidate. We will repeat these millions of times, and this will allow us to estimate what is the estimation error associated with each of these procedures given this set of inputs. So this is the schema of how you would do it. You could denoise or not, depending on what you want to try. Perhaps you denoise in some approaches and not in other approaches. You collect all of the information, and eventually you will reach a conclusion. With these inputs, this is the best approach. I think that in general, you will observe that the methods I describe here are extremely helpful because they go really to the root cause of why Markovich fails, but there is no need to assume this. We should let the evidence speak for itself. Well, I hope that you enjoyed this presentation. If you like this subject and these topics, you will learn more about this in these two publications. In particular, in this new book, Machine Learning for Asset Managers, you can find the code associated with these experiments that I just mentioned. And with that, Thomas, I give you the mic back, and I look forward to your questions.
Yes, thank you very much, Professor Marcos Lopez de Prado, for a great presentation. I would like to remind all the attendees that there is a possibility to ask questions here. If you look at below on your screen, there's a Q&A, so you can type questions, and then I can read them out here. Just to start, I have received a couple of questions here. While we wait for more questions from the audience. So first question I have here is, you talk about denoise in the covariance matrix using machine learning. So how about noise in the expected return before adding it in the portfolio optimization?
Yes, absolutely. So I focus on the covariance matrix because, as you can see from the problem, the covariance matrix needs to be inverted, and this inversion is guaranteed create instability. That doesn't mean that there is also noise in the vector of expected returns, and for that you can conduct a shrinkage on that as well, and that's where you have Stein estimators and so on. So I agree. I focus in this presentation on the shrinkage of the covariance matrix or denoising of certain eigenvalues, but you could also observe an experiment with a shrinkage of the mu's.
Oh, thank you. Then I see we have one question here from the audience, from Lawrence Winkels. How can machine learning help to do variable selection to predict the direction of the stock or bond market?
Yes, in the presentation I've made today, this is an input, right? We already have mu and we already have the covariance matrix. So this is an input to this model. But in general, what you could do is you could look into MDA kind of methods. So the mean decrease accuracy method in particular is very helpful in machine learning to evaluate what are the variables associated with a phenomenon. But there are other methods that are very helpful too. There's Shapley values, there's the line method, there is the PDP method. So there are multiple approaches in machine learning that you can use in order to evaluate whether there is an important feature. Now, let me tell you that this is really one of the strengths of machine learning that is not often understood. When you think of classical statistics, the fundamental way variables are selected is through p-value. And the problem with p-values is that they rely on many relatively unrealistic assumptions, at least unrealistic in finance. And as a result, p-values are not a very good indicator of whether a variable is really involved in a phenomenon or not. And there are plenty of studies that discuss p-hacking and p-value inflation associated with all of the evaluation of all of these assumptions. Fortunately, in machine learning, we have more experimental methods that do not rely on all of these assumptions. So I would recommend you to read the first book I cited at the end of my presentation, Advances in Financial Machine Learning, where you will find many examples of how to do variable selection in finance.
Yeah, thank you. Let me see. We have another question here is regarding the signal-induced noise. Would you agree that when we adjust the returns using an index as S&P 500, we are incorporating noise from an index that is not optimal?
That could be the case. Typically, when you introduce a benchmark or some biases, in fact, there could be some benefits. So it's not necessarily true that when you incorporate some biases, as a result, the system is going to be unstable. In fact, if you remember from statistics, there is something called the bias variance trade-off. And sometimes you may want to introduce biases on purpose in order to reduce the mean square error of the estimator. So I would say experiment. Take your approach, run it following the method, the Monte Carlo paradigm that I described here, and see what the results are, and experiment. It will be very hard to reach a conclusion as to whether introducing some form of bias or not is going to be detrimental. Sometimes it will, but if the system is extremely noisy, in fact, adding some bias may be helpful to reduce the root mean square error.
Yeah, thank you. We have one more question here from Alexandre Rubisam. He says, the clustering approach you mentioned is very intuitive in the context of a stock portfolio. Would you please comment on the challenges of applying this approach to a multi-asset class portfolio?
Well, for a multi-asset class, instead of using a clustering method, you could use a different approach. You could use, for instance, a knowledge graph, right? In a knowledge graph, think of a knowledge graph as a modern covariance matrix where you can evaluate how various securities are interconnected, and you can identify what is the minimum spanning tree associated with that knowledge graph. And that's going to give you essentially the various clusters. So that would be another approach that is not just based on the clustering of the correlation matrix. Another method would be, instead of clustering the correlation matrix, you could do clustering on the distance matrix derived from the mutual information between the securities. So instead of looking for linear codependence, what you could do you could apply information theory to estimate what is the mutual information between the securities, and then use the distance between these securities as derived from mutual information to cluster. So there are various ways in which you can generalize this approach to beyond clustering of a correlation matrix.
Oh, thank you. See, another question here is, we all know bad data equals bad models. What recent advances have you seen in data sources? I know some quant funds have access to aggregate debit and credit card spending data for predicting quarterly results in retail, for example, Amazon.
Yes, so data is one of the most exciting areas of progress. 3 years ago, these data sets didn't exist, right? When you think of credit card transactions or micro lending, or whether it is email receipts, information that comes from manufacturing and engineering processes. So there are today tons of observations, and in a sense, this old framework where everybody just used a correlation matrix is today very limited, right? And that's why in the previous question, I referred to knowledge graphs. So my suggestion is that rather than relying on the old data, we all pay attention and take a look at the new sources, and we experiment with these new sources. So in the previous question, we tackle how to optimize a portfolio of multiple asset classes. Well, to understand the connection between multiple asset classes, perhaps a correlation matrix is too limited. So instead of using a correlation matrix, we use a knowledge graph, and we understand the codependencies. Sometimes they are synchronous, sometimes asynchronous codependencies between the various variables. And we use that information to model their mutual relationship. So that would be an approach that is based on alternative data. Why? Because it's not simply based on running regressions and computing correlations. We're going to incorporate information that comes from more advanced estimators, machine learning algorithms, but also information that comes from the analysis of the securities. You see, when we compute a correlation matrix, we just run some estimators, and we utilize that information, and we cannot really manipulate the correlation matrix, right? We change some value that we think is extreme. As a result, the correlation matrix is going to turn inconsistent, and it's not going to be useful. But a very good advantage of machine learning is that, in fact, these approaches are open and transparent. We can modify the knowledge graph, and that's not going to break the model. We can actually incorporate information, a priori information that we know about the knowledge graph, and follow through the method. So in conclusion, yes, we should definitely use all of these data sources. And when we do so in a machine learning framework, we can combine many different sources of information without having to align them in a particular way, like, for instance, when we compute a correlation matrix.
Oh, thank you. Another question here is, what do you think about using filtering methods to remove noise from financial data? Are they not powerful enough to solve noise problems that you mentioned?
Yes, they are. Look, you could use, for instance, a Kalman filter to try to smooth some returns. And I think that's a good idea. You should always experiment. So the fact that Kalman filter works very well in some fields, it doesn't mean that it's going to work well in finance. You should try Kalman filter. You should try Stein shrinkage. You should use Ledois-Wolfe shrinkage. You should use denoising and experiment. Run Monte Carlo experiments to see what approaches exhibit better mathematical properties given the set of inputs and the size of the problem that you are tackling.
Okay, I think we have time for one more the last question here. That is, how can machine learning be applied in empirical asset pricing? That is, choosing the optimal investment factors in a dynamic model and to explain why investment strategies work or don't work.
Yes, so this is a huge topic. I will refer you to the first book I mentioned at the end of the presentation, Advances in Financial Machine Learning, where I describe machine learning methods that are useful in the context of time series analysis, right? And that's really the main difference between the problems we analyze in finance compared to other problems like, for instance, face recognition or problems associated with natural language programming, sentiment structure, etc. When we deal with price prediction in finance, we care about the time series. And we cannot assume that the observations are associated with IID processes, and very often the features will not be stationary, etc. So there are all of these characteristics of financial problems that are not in compliance with the basic assumptions of machine learning, and that's why I discuss financial machine learning as a field in its own right. We need to tackle issues of time dependence and non-stationarity that are quite peculiar in finance. And in the case of price prediction, all of this matters because we will have to deal with the fact that some prices exhibit co-integration and some prices exhibit heteroscedasticity, that there is serial conditionality in the observation. So it is a huge topic and there are no easy solutions, but some methods seem to work better than others, and that's what I discuss in that book.
Yeah, well, thank you very much. I guess that brings us to the end of the presentation. It's really been an honor having you here. So thank you very much for being here with us today and telling us about or presenting your research, answering the questions. Thank you.
My absolute pleasure, and stay safe. Thank you.
Thanks. So then that brings us to the next part of the program. We will have the final of our call for papers. So about a month ago, we sent out the call for papers related to the subject, which Professor Marcus Lopez of Prado has been talking about. It's related to machine learning for asset management. We have the jury here with us. The jury has read all of the papers, and we have selected 4 finalists. The 4 finalists will each shortly present their paper in a 5-minute pitch, followed by a 5-minute Q&A session. After that, we will select the winner. The winner will receive a prize of 20,000 Norwegian kroner and the opportunity to be part of a Norquant internship. We have a jury here. The jury here consists of Alberto Guillen Jimenez. He's head of analysis at Norquant and formerly responsible for factor strategies at Norwegian Bank Investment Management. We have Professor Laurens Swinkels. He's a research director at Robeco and professor at Erasmus University in Rotterdam. He's also a board member of our association, Norsk Forening for Kvantitativ Finans. Joining us online, we have Kjersti Aas. She is a director of Norsk Regnesentral and also board member of our association. And we have Wu Letran. He's a researcher at Nord University. So the 4 finalists that we will be hearing from today, it's in a random order, but this is the order that we will ask them to present their papers. First of all, we will be hearing from Eirik Selander. The name of his paper is Measuring the Importance of Asset Pricing Factors Using Machine Learning. After that, we will hear from Signe Kilskar. She will be talking about aksjeutvelgelse ved bruk av random forest. The paper is in Norwegian, but the presentation will be in English. Thirdly, we will be hearing from a paper written by two students. It's Mons Eile and David Fang. The name of their paper is Evaluating Value at Risk and ES for Commodities, both conventionally and with neural networks. The last presentation will be from Emilia Alarcon. She will present her paper, Cryptocurrency Market Returns. So then let's get started with our first presenter. This is Eirik Selander.
All right, thank you.
I give the screen. Yeah, you.
Let me share the screen.
Yeah, I guess I have to share the screen here with you now. Yes.
Yeah, can you see the screen?
Yes, we see it here.
Okay, cool.
Go ahead.
All right, so yeah, hello everyone. My name is Eirik Selander, and I'm going to present my dissertation, as mentioned, titled Measuring the Importance of Asset Pricing Factors Using Machine Learning. So I'll start by discussing the problem, the methodology, look at the findings, and then finally the contributions and implications of the paper. So one of the great problems in empirical asset pricing, this was already alluded to previously, but which is estimating conditional expected stock returns. Now, given that this is a prediction exercise, it would be interesting to know, which variables are important for this prediction problem. So that's one of the motivations. Now, the other one is from a more of a practitioner's point of view. So there are some evidence showing that the correlations of asset prices have increased over time. And if that's the case, then it will be useful to have a system that can continuously look for predictive signals. And also, given the increased saturation in the markets, it's also, makes it important to look for predictive signals continuously. So the research question is then, which variables have the greatest impact on the prediction of stock returns? Now, why should we use machine learning for this? Traditional models have struggled to do this when you have a high number of variables, and also when there are non-linearities. So models like linear regressions can struggle in these situations. Machine learning allows for this. Obviously, I discussed this in further detail in the paper. And we can do this now because of the increased data availability and computing power. Now, I look at data from Japan, the US, UK, and Norway over the following 28-year period. I use monthly frequency, and I look at 42 predictor variables. Now, I focus on firm characteristics and price signals in this paper. And the methodology I use is I test 6 models listed here. And then to measure the variable importance, which is the main issue, is I look at permutation importance and SHAP values for robustness. So the most exciting, and then my approach is to look at first the most accurate models for these data sets, so we can get kind of an accurate description of the variable importance. Now, these are the variables I look at, and I test some new variables as well, which are listed here. These are all obviously available in the paper. So the findings, firstly, I find that bagging, random forest, and gradient boosting achieve the highest accuracy across all the geographies and all the data sets. These are all nonlinear models, so it kind of makes sense to what was mentioned previously. And in terms of the variables, I find that price models, price signals of various kinds like momentum and return volatility are highly predictive. The lowest predictive category is accounting ratios. There are some kind of deviations to this, so earnings yield does okay, but still the overall price signals do the best. So the only difference from other papers were that liquidity factors didn't do as well in my paper as compared to some recent papers. However, the findings are robust across countries and after redoing the analysis with the alternative measure of variable importance, the SHAP values. Now, what are the key takeaways? It's a generic framework and it's easily applicable to other settings. So hedge funds and asset managers can use this approach to investigate other data sources like macroeconomic variables like GDP, unemployment, interest rate, or alternative data like social media feeds, satellite images. And the code is kind of easily put into a Jupyter notebook, so the user could just change the data source and then just redo the analysis and get signals continuously. So in the paper, I go through kind of some applications. So I construct. Sorry, this is a bit small, but I construct some factor portfolios, both single factor and multi-factor portfolios, and I look at the kind of change over time compared to the market index. And then I look at the correlations of the different portfolios between the returns of each portfolio. So they can be used for kind of factor tilting and things like this. I also look at the Sharpe ratios and the rolling Sharpe ratios over time. So that's what I go through. So just to conclude, so it contributes to the literature by, so it's kind of a growing literature of testing machine learning models and testing variable importance for machine learning for financial applications. So I contribute to this literature by testing for geographical differences of recent findings, because most of them use similar or the same data sets from the US. So I wanted to see if it held up using a different data set. I test 8 new predictor variables, and I confirm the price signal findings from a lot of the recent papers mentioned here. So in general, I think this kind of research gives insight into kind of the statistical processes that drive stock returns, and it gives kind of insight into that black box, and so we can give some economic rationale. And it provides investors with useful modeling tools. And as was mentioned already as well, noisy nature of stock markets poses a challenge to retest to get predictive signals over time. So lastly, I'm sure how I'm doing on time, but last I just wanted to mention some things that can be looked at for future research that weren't necessarily looked at in my paper, but that are relevant. So, how has the variable importance changed over time? Sampling frequency, because obviously some data sources are sampled at different frequencies. So, accounting ratios are less updated than the prices. Transactions costs. I didn't use deep learning in my paper, so that would be something to look at. And then as Professor Prado is working on, I know, is kind of developing more custom machine learning algorithms, that are more custom made for financial applications. So that's it. So thank you.
Yeah, no, thank you very much for a very interesting presentation. Then we switch over to the jury that we have here with us. Are there any questions about this presentation? Yes, Laurens?
Yes, I have a question. In your paper, I think you highlighted more than during the presentation, but that
1-month momentum is one of the strongest factors that you find in your procedure. So now I was not completely sure because the literature, for example, Jagadish in 1990, they find a strong reversal at the 1-month horizon. So the opposite of momentum. So is it that you find also a reversal, so a negative sign for this 1-month momentum, or do you find the opposite result? So really a positive momentum result for the sample that you look at.
So yeah, I think for my case it would be an opposite finding. I am familiar. I'm not sure if I'm familiar with that particular paper, but from the paper I listed here. Sorry.
You refer to Jagadish and Titman, I think, in the thesis at least. So.
Yes, sorry. So yeah, that was based on kind of where the momentum factor was first kind of introduced. Mm-hmm. But in terms of the findings, I think some of these papers listed here find similar that momentum has a high predictive signal. But yeah, I suppose the finding you mentioned there, mine is a bit different. Yeah.
Mm. Okay.
Yeah, thank you very much, Eric. Now we will proceed with the next presentation, which will be Signal-induced presenting on a paper titled "Stock Selection with Use of Random Forest." Yeah, please, Signal.
Okay, I'll just have to share my screen. Let's see.
Yeah.
There. Okay. Okay, so first of all, I want to thank you for letting me participate. My name is Signe, and I'm going to present to you my paper, which is titled "Stock Selection Using Random Forest, a Machine Learning Approach to Excess Return." Read this. So my study implements the machine learning method random forest for stock selection. And the purpose is to examine whether the method is capable of discovering patterns that contribute to excess returns in the Norwegian stock market based on both technical and fundamental features. Okay, so between approximately December 2010 and May 2019, I select 10 stocks for an equally weighted portfolio at each rebalancing day, which are based on probability rankings from the random forest model. In total, I construct 3 portfolios to check how robust this method is. The first portfolio, which is my main portfolio, is created for a long holding period based on both technical and fundamental features. And the other 2 portfolios are created for a short holding period of 1 day. And the first of these 2 is based on also the combined feature space of both technical and fundamental features, and the second of these 2 portfolios is a pure momentum portfolio. So all 3 of these portfolios generate significant excess returns before transaction costs, and they greatly outperform the OCBX, which is the benchmark, when these costs are not taken into consideration. So before transaction costs, the portfolios achieve Sharpe ratios of 2.14, 5.13, and 5.55. For the portfolios with the portfolio with the long holding portfolio, which is my main portfolio, the transaction costs are not that high, so the performance is still high after transaction costs. But for the portfolios with the short holding periods, the returns are drastically reduced after transaction costs because they have a high daily turnovers. So as you can see from this paper, the portfolio returns are not stable over time. And when looking at the trend, it does show a decreasing trend over time, which is present in all the 3 portfolios. And it's also in line with previous research that my study is based on. So this could be a result of the increased popularity of machine learning techniques. The potential does, however, not seem to disappear over the period. In addition to generating the portfolios, I also check for variable importances from the training datasets. And these illustrate that there is a relationship between the selected features and the returns. So this figure shows the variable importances for the portfolio with a long holding period. So for the long holding period, the long-term technical features, as well as some of the top fundamental features here, are the most important ones. In the Norwegian market, it does seem as that especially volatility is an important feature for returns, and this applies to both the long holding period and the short holding period with the combined feature space. For the short-term momentum strategy, the most important price movements for the returns does seem to be the ones in the days prior to the stock selection, as well as more long-term price movements. When these variable importances are seen in relation with the returns, these results from my study must be said to pose the challenge to both the weak and the semi-strong form of market efficiency. So let's see. During the approximately 9.5 years of the trading period, the selected stocks for my portfolios mainly contribute positively to portfolio returns. So this table shows the top 10 selected stocks for the portfolio with a long holding period, and shows that on average, these stocks contribute with an average monthly return of 8.1%. And this proves that the model is both robust and reliable at generating positive returns. So just to provide some concluding remarks, my study shows that the random forest model has potential for generating excess returns in the Norwegian market for both the short-term and the long-term holding periods. This means that there is potential for profitability with the use of machine learning techniques that discover and exploit patterns in financial data. When I ignore transaction costs, the potential is especially high for the short holding period, but the profitability is, however, extremely dependent on being able to get low transaction costs for these portfolios, as they have high daily turnovers. So machine learning techniques, and particularly random forest that I look at, should be of interest and be useful for both traders and portfolio managers, as it not only helps in generating returns, but it also helps to illustrate important patterns for the data. So yeah, thank you. I hope you heard that.
Okay, thank you, Signe. I have a question. You showed that you find Sharpe ratios that are between 2 and 5
Yes.
after the thesis. So that sounds almost too good to be true to me.
Yes.
So I was just wondering, could it be that you are making use of some, let's say, information with hindsight that you would not have really had in real time, or that you do some data mining to get these good results? Or what's...
I have adjusted all my data, so it should not use anything that is not available at the time. My method, it doesn't make assumption. It assumes that I can buy it close to price, sell it close to price. So some parts of my methodology would not be entirely able to do in the Norwegian market as it is now. However, it does follow the methodology of other studies that show similar results, and the extreme high results, Sharpe ratios from the portfolios with the short holding period is before transaction costs. So using transaction costs, I think the ones that are given to a regular investor, the strategy will not be able to give those excess returns. So those strategies are dependent on getting especially low transaction costs to be able to be profitable.
Okay, thank you very much, Signe. So now we move on to the next work authored by Mons Eile and David Fang. Yeah, so please, Mons, go ahead.
Okay, thank you very much. So since it's two of us and we have a limited time of 5 minutes, I will conducting the presentation and then we will both answer your questions. So let me just share my screen here. Okay, so our master's thesis then is called Evaluating Value at Risk and Expected Shortfall for Commodities, both conventionally and with neural networks. And briefly then, an agenda for this presentation is an introduction to the subject and a brief section about the data and methodology, and then the conclusions of the thesis, especially for the ANN part. So as we all know, risk management is becoming increasingly important in asset management. It is one of the most important factors in delivering sustainable and high returns over long periods of time. And within this area of research, the most commonly researched assets have been stocks and bonds. We actually found commodities to be an interesting asset class to investigate, as it offers diversification means. It often has low or negative correlation to stocks. And furthermore, the volatility pattern of commodities is deviating somewhat from traditional assets in its high and sometimes extreme volatility with clustering properties, as well as nonlinear properties. So the conventional way in modeling and forecasting clustering volatility has been the GARCH-11 approach, where the volatility forecast of tomorrow depends on today's volatility as well as today's unexpected deviation. However, the inherent drawback of the GARCH-11 is that it is not model-free, meaning that it imposes an explicit relationship onto the data. And especially when we see nonlinear properties of the volatility as we do for commodities, it can sometimes be hard to find a conjunction that very well fits the volatilities. So therefore, we looked at an alternative machine learning approach, namely the artificial neural network, as it has great predictive abilities and is very well specified to map nonlinearities and complex data sets. And more specifically, we looked at the long short-term memory, as it is very well specified for sequential or time series data. And then again, the main advantage of the artificial neural network is that it is completely model-free. So there is no pre-specified relationship, which in this case should work very well. So then about the data and methodology, the commodities examined were oil, gold, and soybean, as these are three of the most traded commodities within their respective sectors. Oil has amongst the highest volatility out of all commodities and is the most produced and traded. Gold has often been seen as a hedging mean to the stock market that rises in times of uncertainty, and soybean is one of the most traded agricultural commodities. So the time period evaluated was 30 years between 1990 and 2019 due to the start date of the indices examined. And so then the volatility estimates received by the ANN and the GARCH-11 were utilized in a volatility-weighted historical simulation to conduct the VAR&ES estimates for each day in the testing period, and then they were evaluated against the loss of that day. And so for the ANN, the only predictor of future volatility was daily realized volatility. So that was the sole predictor. And this approach was carried out for three different confidence levels of value at risk and expected shortfall, 95%, 97.5%, and 99%. And then we utilized three different tests. The QPX test to test the amount of VAR violations received against expected amount. The Christoffersen's independence test to test the independence of the violations and to see that they're not too clustered together. And finally, the testing ES directly test introduced by Akribi and Sikli in 2014 that tests for the average VAR exceedance, which is the same as testing for expected shortfall. And then for our conclusions, even though the dataset was on the small side for artificial neural networks with only approximately 7,500 realized volatility observations, it did overall perform remarkably well, with well-specified VAR&ES estimates that passed 26 out of the 27 tests, with the one exception being QPX test for gold on a 95% confidence level. It did outperform the GARCH-11 in terms of forecasting accuracy, as could be seen by a lower mean squared error and mean average error. So since the network implemented had somewhat of a simpler architecture with realized volatility being the only predictor, we do see great potential to scale the network when time and computing power is not as limited. We basically computed the network on our laptops. So in its forecasting prowess, we do see potential to implement more complex neural networks in forecasting volatility of other asset classes, as well as forecasting prices. So thank you so much for listening, and we now welcome your questions.
Yeah, thank you.
Okay, thank you. In the empirical application, it seems you used two spot indices and one excess return or futures-based, derivatives-based index, if I remember correctly.
Yeah.
Since you cannot really trade in large quantities in spot rates, and futures prices can move differently from spot prices, was there a specific reason to look at spot prices, or would you expect that the results you have also carry over to future contracts, forward contracts?
Do you want Okay. So actually, it's kind of funny because when we were sorting the data from Bloomberg, we found that it didn't provide a total return or excess return for all of the commodities that we wanted to investigate. So first of all, in the beginning we saw this as somewhat of a problem. However, we did examine for gold that had both the excess return and the spot return index, and we saw that they were highly similar. So even though, of course, the futures price can deviate from the spot price, we still think that it should be viable, as I think the spot price was only used for one of the commodities and the excess return was for the two others. So ideally, we would have wanted to use all futures or excess return indices, but I still think that the results are viable.
Okay. Thank you very much. And with this, we will move on to the last presentation.
Yep.
It will be Emilia Alarcón presenting a work named Understanding and Predicting Cryptocurrency Market Returns. Yeah. Please, Emilia.
Yes, hello. I'll share my screen. Okay. Okay, so my name is Emilia Alarcón, and I will present Understanding and Predicting Cryptocurrency Market Returns. The potential for making profits investing in cryptocurrency, the hedging benefits, and their role not only in global economy but also in the digital future make it relevant to study the determinants of cryptocurrencies and analyze different returns prediction models. Recent studies have focused on one or some cryptocurrency. This study will analyze the cryptocurrency market as a whole. The purposes are to identify the determinants of the cryptocurrency market and to find a returns prediction model. For this, machine learning techniques that have gained a lot of attention because of their prediction accuracy will be used. A data set including all cryptocurrencies was extracted. It was observed that 11 cryptocurrencies with largest market capitalization represent 90% of the total market. Therefore, these 11 cryptocurrencies are used to calculate a cap-weighted index, which is transformed to returns and is the response variable for this study. Sorry. Okay. The explanatory variables are 41 features that are divided in cryptocurrency market data, information demand, commodities, exchange rate, financial markets, and macroeconomics. To determine the methods to be used in this study, the trade-off between interpretability and prediction was considered. Lasso, being less flexible than least squares, is also more interpretable, and is therefore selected to find the determinants for the cryptocurrency market. In this case, the features and the returns will be analyzed in the same day to see the immediate relationship. For prediction, it is known that more flexible methods can give better predictions if the relationship between the predictors and the response is nonlinear. Therefore, different levels of flexibility are tested using lasso, regression trees, random forest, and boosting trees. And in this case, data in the inputs, one day before data in the inputs is used, and the last value of the returns is included in the model. And according to the variables selected by Lasso for prediction, a new data set is constructed. So all the methods in prediction will be tested in the all predictors dataset and in the Lasso predictors dataset. And then these models will be compared using the test mean square error, being the method, the model with the lowest test mean square error, the one that has best prediction accuracy. The results show that analyzing the features and the returns in the same day, Lasso selected 14 features from the 41 used. These include cryptocurrency market data, the high, low, open, market cap lag, and volume. Also some stock market indexes as the Dow Jones, NASDAQ, and IMOEX. The commodities as gold, gas, and oil as well, with a lower effect in the returns. And the exchange rate, dollar to ruble, and the volatility index, VIX. For prediction, Lasso found that 5 variables have prediction power. These are the dollar to Chinese yuan exchange rate, the stock market indexes, the Nikkei and the BSE, market cap, and gas. And comparing prediction performance between the models used, it can be seen that random forest with all the predictors dataset is the one with the lowest test mean square error, followed by random forest with the Lasso predictors dataset, then is boosting, Lasso, and regression trees. So the cryptocurrency market variables are the most important determinants of the cryptocurrency market returns. The stock market indexes, Dow Jones, NASDAQ, and IMOEX have a positive relationship with the returns, implying that the hedging benefits of cryptocurrencies have to be carefully considered. Gold affects the returns positively and the dollar to ruble exchange rate negatively, and gas and oil seem to have a low effect in the cryptocurrency market. Regarding prediction, the dollar to Chinese yuan exchange rate emerged as the most important determinant. The model with lowest test mean square error was random forest with all the predictors dataset. So this can be a model that can be used to predict the cryptocurrency market returns, suggesting also a non-linear relationship between the predictors and the response. Boosting did not outperform random forest. This could be because cross-validation was used to determine the tuning parameters for boosting, and boosting may have overfitted the data, which random forest didn't do. Thank you.
Thank you very much, Amelia. I don't know if we have some questions from the jury. No.
Yes, I have a question about you used 11 cryptocurrencies, and when,
Yes.
at what period in time did you select them? Because I'm a bit worried that when you select the largest cryptocurrencies at the end of the sample period, that those were not necessarily the largest cryptocurrencies in real time. So there's some survivorship bias in the return of the index that you're trying to predict. Is that a possibility, or?
Yeah, I selected the 11 cryptocurrencies in May, the 1st of May, and that's where I found the ones that had the largest market capitalization. So at that time, I selected the 11 cryptocurrencies, and then I analyzed this through April 29, 2013 to May 1st, 2020. Yes, so they were selected at my first.
At the first data point or at the last data point?
The last data point.
Okay. Thanks.
Well, and another question is, you have analyzed an index of cryptocurrencies. Have you happened to analyze individual cryptocurrencies following your methodology?
No, I didn't. I calculated with these 11 cryptocurrencies with largest market capitalization, I calculated an index according to the KPM portfolio determination, where assets are weighted according to the presence in the market. So this was the index that I used during all the study. I didn't analyze each currency individually.
Thank you. Good. Thank you very much, Emilia. And thank you very much, all the presenters, as well as all the other submitters. Yeah, it has been a very high level among the finalists, and yeah, all of them could be a winner. So the jury has voted, and I must say that by a very small margin. So all the 4 finalists are actually really good, but by a small margin. So we have a winner, and then the jury has decided the award of 20,000 Norwegian crowns, as well as an opportunity to take an internship at Nordquant, has been awarded to Signe-induced for her work on stock selection using random forests. So congratulations to the winner. Also, thank you very much for all the participants. Yeah, so with this, we conclude our seminar.
Yes, thank you very much. Thank you for the jury. I think it was a great presentation, 4 very interesting papers, and we have a winner which we will contact afterwards. Thank you all for attending, and we hope this will be the first one of many webinars for our association, and of course that we will be starting with seminars again when that's a possibility. So thank you very much. We end the webinar here.
Thank you.
Thank you.
Thank you.